You too, Scott.
Things changing all the time, obviously. Do we answer any questions today? I mean, are we closer to a bottom in your mind?
Every day that goes by, I think we are certainly closer to a bottom. Are we at a bottom? I think for the market as a whole, I'm not sure. But we are seeing some signs that we might be near a bottom for some stocks.
The problem seems to be what's priced in, what's not priced in. What was priced in last week felt like, or in the last couple of weeks, felt like it was tightening was starting to get priced in, right? The market had come down a lot, come into grips with the fact that Fed's going to be really aggressive moving forward. Now it feels like we need to assess the issue of whether big slowdown and recession are accurately priced in, and it feels like the market's confused about what to figure out right now. Exactly.
Yeah, so, I mean, the approach that I take is, to your point, what is actually priced into the stock today? Is a recessionary scenario priced in, or does the valuation suggest that people expect earnings to fall significantly already? Or is the valuation such that people expect, good times ahead? And so, we're very cautious on names that aren't already pricing in some type of slowdown.
Scott Minerd of Guggenheim, the chief investment officer, was on with me yesterday, and his view has grown more bearish. He once suggested, and not that long ago, that you had a pretty good ramp for the market until the Fed and things really got serious heading towards a recession. He changed his view because in his mind, the Fed is more aggressive and the economy is slowing. I want you to listen to what he told me about what that means for stocks in the environment. Let's listen to Minerd. We can chat on the other side.
Given the aggressive posture of the Federal Reserve, we're going to be meaningfully lower this year in stocks before we find a bottom, because the Fed has made it clear that they do not have a put on the stock market. They've made it clear to us that we're going to be at 1.75% by July. I mean, I think a 50 basis point hike has been advertised for the next two meetings, and they believe that the neutral rate is somewhere higher. So I think at that point, the Fed will be an overkill. The weakness in the economy will dominate, and we could be setting ourselves up for a season of pain here, especially going into September and October.
Setting ourselves up for a season of pain. You agree?
I think that there could be more downside ahead for the economy. I'm concerned about it, but I don't think it's universal. I don't think that every company and every sector is going to be hit. But, certainly it's indisputable that, rising rates are slowing rate-sensitive sectors. We're seeing major drivers of the economy, such as like e-commerce growth, software growth, starting to slow. Demand for some consumer discretionary starting to slow. And the issue is that when you have those slowing effects and you potentially have and you do have market declines, those can lead to a self-reinforcing cycle that makes the overall environment a little weaker.
Look, you haven't been afraid to stick your toe in and recommend some retail stocks, right?
Right.
With me on this set.
Yes.
Now I'm wondering, and it feels like for many, Target and Walmart were a game changer for a variety of reasons, but that seems to be what has most unsettled many because of high inflation, the lack of pricing power, margins coming down, earnings getting reset. How do you see it?
Yes. So I think it's interesting because I had been watching both those companies very closely and been concerned about starting to see some more promotional intensity come in and what that might mean for the entire economy. And I think, look, those stocks have been hit and even a follow through today because they're not trading at cheap valuations. I mean, their Target's not expensive here. Walmart's, for the quality of company it is, it's not expensive, but they're not cheap. And so I think people were really caught by surprise that they could have this economic sensitivity. So I think where we're dipping our toe in are retail stocks that are trading at like 5 times earnings. They're trading below pre-COVID levels where a recession scenario is already priced in. And what we've seen is in the past couple of days even, we've seen some of these companies report and even guide down for 2Q or guide down, for the year. And the stocks are ripping because the valuations are so low. Now, we do have a lot of stocks that are ripping independent of any news just because people are chasing the junk. But I think in these cases, like the fact these stocks are up on earnings that maybe even they were down in the pre-market, but they rally because how bad are earnings really going to be?